Hello, and thank you for tuning in to the Fi Mastery Podcast, where our focus is on providing tools, resources, and insights that empower driven individuals to secure their own path to financial independence. My name is Peter Donisanu, and today we're going to talk about why interest rates aren't likely coming down anytime soon. The fact is that this year's rally in the stock market has largely been driven by expectations that the Fed will cut interest rates later this year. Even so, incoming data suggests that the factors that largely influence inflation have not slowed, which means that policymakers likely will need to keep interest rates higher for longer in order to put a damper on rising prices. That's why in today's episode, we'll review the factors affecting inflation, what it likely means for the markets, and most importantly, what it means for your finances. So with that, let's dive into today's podcast. If you've been hoping for interest rates to fall this year, I've got some bad news for you. It's that borrowing costs likely will only go higher from here. At least that's what we're hearing from various Fed officials over the past couple of weeks. More specifically, these individuals have been telling us that the central bank should continue raising interest rates into the foreseeable future, and the fact is that incoming data support their case for future rate hikes. To this point, inflation data for January show that prices accelerated at a faster than expected rate, rising 0.5% on a month-over-month basis. What's more, the data also show that U.S. labor market conditions remain robust in January as employers added well over 500,000 jobs to their payrolls, besting economist expectations of a payroll growth slowdown. And if that wasn't enough to dash the market's hopes of lower interest rates later this year, government data just recently showed that households spent at a faster than expected rate of around 6% last month compared to a forecast of less than 5% for January. Now, if we're in a recession at this very moment, then it's possibly one of the strongest economic environments we've experienced in a while, heading into the start of an economic downturn. Now, this perspective is relevant because history tells us that the Fed tends to pause interest rate hikes as the data begins to turn to the downside. And so far, while there is some evidence of slowing economic activity, the data does not make a solid case that would prevent policymakers from not raising interest rates from here. Now, if you've been following along with the markets, then you likely know that some investors anticipated interest rates to only rise modestly this year. Thereafter, the hope was that the Fed would pause its rate hike cycle and eventually begin cutting rates by the end of the year as the expected recession unfolded. Now, this market narrative was a key factor driving risk after performance in the first few weeks of the year. Indeed, U.S. stocks in January had one of their best starts of the year in a long time on hopes that the Fed would eventually pivot away from aggressive rate policies and pave the way for a market rally later on the year. For example, at the start of the year, markets were pricing in a quarter-point rate hike by the FOMC in February and in March, followed by a pause in rate hikes and then an eventual rate cut by the end of the year. Nevertheless, as January came to a close and key economic data began rolling in for the month, it became clear that economic conditions don't yet warrant rate cuts this year. Indeed, incoming economic data suggests that a severe economic downturn hasn't presented itself yet if we look at the health of the household as a key barometer of economic activity. Certainly, this activity is critical to note because nearly 2/3 of gross domestic product, or GDP, is made up of household spending alone. So from this perspective, a case can be made, and in some cases already has been made, that policymakers will need to continue raising interest rates until something breaks in the economy or in the financial system that would eventually warrant a rate cut. So then, what are some conditions that likely need to be present for policy rates and hence borrowing costs to fall later this year? Well, for now, developments in the housing and labor markets likely will be critical indicators for confirmations that the economic conditions have slowed to levels that support lower inflation over the long term, which could give policymakers the cover they need to take their foot off the policy brakes. And by this point, you may be asking yourself, well, why is housing such a critical factor in the Fed's rate calculus? Well, that's because what happens in the housing market is a critical measure of inflation. More specifically, it's because housing costs, as it relates to its contribution to overall inflation, makes up a sizable portion of the Consumer Price Index or the CPI basket. Indeed, over the past couple of years, owners' equivalent rent or the cost of housing has skyrocketed from an average below 3% from 2010 to 2020 to nearly 8% in January of this year. What this means is that it's becoming more expensive for households to keep a roof over their head as the cost of servicing a mortgage has risen and average rents nationally continue to climb. And while activity in the housing market has slowed over the past year, incoming data show that conditions have actually stabilized in the housing market. For example, while inventories of new and existing homes went up mid last year as buying activity slowed and the Fed began raising interest rates, the number of homes available for sale presently is falling back to levels we just saw a year ago. What's more, home builder sentiment improved in January at a better than expected rate as home buying activity remained resilient in the face of rising borrowing costs. And the big question for many economic observers is, shouldn't have rising borrowing costs killed consumers' appetite for home ownership? And the answer is no. Data released this week showed that first-time home buyers made up the largest portion of new home purchases and existing home purchases in recent months. And why are buyers so resilient amidst rising interest rates and all this economic uncertainty? Well, one of the reasons why home buyers have remained resilient is because wages continue to rise and hiring in many parts of the labor market remains robust. Data released in early February showed that employers added another 500,000 jobs in January, nearly double the rate that many economists had predicted for the month. And with interest rates rising and the economic outlook seemingly so uncertain, why would we continue to see more jobs added from one month to the next? Or maybe put a different way, why is the labor market still so strong even when other indicators have suggested for months that the US economy could be headed for recession? Now, while there is a myriad of explanations for this uncertainty, the fact is that there are many demographic shifts that have taken place over the years that have led to stubbornly strong labor market conditions today. For example, in the pre-pandemic era, employers had been looking for qualified workers and had difficulty filling those open positions. This reality is exhibited in the upward trend that we see in the JOLTS or the job openings time series data. And given that employers were once challenged to bring on new workers, they're now less willing to let go of those same workers, even as a slowing economic outlook puts pressure on earnings and margins. And recently, with prices increasing and labor market shortages abounding, business owners have used inflation as a cover to raise the prices of the goods and services they sell so that they can pay higher wages and pass those costs along to consumers. Indeed, in January, average hourly earnings grew 4.4%, a slowdown from the 6% in early 2022, but remains well above the less than 3% average that we've seen over the past decade. What this likely means is that households increasingly have more money to spend as employers pay new workers higher wages or offer outsized cost of living adjustments to existing employees as a means to keep them on board. So amidst all these developments, what exactly does this mean for the markets? Well, the conditions that would have justified just 2 more rate hikes this year and that led to a solid risk asset rally in January are likely no longer present. To be sure, as it stands today, market participants, in fact, are pricing in 3 more rate hikes this year. And what this means is that we're likely to see heightened market volatility in the weeks and the months ahead as investors look for a new narrative to support the nascent cyclical bull market rally for the year. And so what factors will market participants be watching to evaluate market direction looking out into the rest of the year? Well, as recent data have demonstrated, the health of the consumer likely will be central to the market narrative this year. And directional data points relevant to this measure include the resilience in the labor and the housing markets. The hope among many investors likely will be that as activities in these sectors of the economy begin to weaken, so will inflation. And as inflation data confirm what the housing and labor market tell us, investors likely will have the confidence they need to move ahead of policymakers once again and drive risk assets higher in anticipation of an eventual Fed pivot. Until then, we continue advocating for an investment strategy that is consistent with your long-term risk tolerance, goals, and objectives, and most importantly, your financial plan. Indeed, now may not be the time to take on additional investment risk as investors are trying to figure out which direction the economy and the markets are headed. In fact, given the strong rally this year and renewed macroeconomic uncertainties, we continue advocating for a disciplined cash management plan, especially for those investors who are currently drawing down on their savings to fund their post-employment living expenses. Outside of investing, it's vital to note that financial markets are pricing in rates to go up another 0.75% this year. And what's more, policymakers have indicated that interest rates likely will need to stay higher for longer. Therefore, if you need to borrow money to make a purchase, consider your options, as the potential for refinancing at lower rates likely may not come for more than a year or even longer from then. On the flip side, higher interest rates have finally made it beneficial for individuals to hold cash. Now, while purchasing power of cash continues to be eroded on an inflation-adjusted basis, you now have more options in today's environment to put your money to work in a relatively risk-free manner. For instance, many financial institutions now offer savings and certificates of deposit or CD accounts that pay interest of around 4.5% and even 5%. This reality is especially salient given that if we're headed for a recession in the second half of the year, then preparing an adequate cash buffer to weather an economic downturn is essential now more than ever. But make no mistake, borrowing costs are only likely to go up from here. And as a result, we're likely to see higher levels of market volatility and economic uncertainty in the months ahead. That's why even after a solid start to the year in the markets, it's essential to avoid financial complacency. Indeed, taking a few steps right now to position your finances properly likely will put you one step closer to mastering your journey to financial independence. Well, that's it for now. Thank you for taking the time to listen to the FI Mastery podcast. To learn more about our research, visit us at fimastery.com or email your questions to questions@franklinmadisonadvisors.com. Until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
FI Mastery Podcast is brought to you by Franklin Madison Advisors, Inc. Franklin Madison Advisors is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. This commentary and forecasts are limited to the dissemination of general information pertaining to Franklin Madison Advisors investment advisory services and general economic and market conditions, and are subject to change without notice. The information shared today is not intended to be personal, legal, investment, or tax advice, or a solicitation to buy or sell any security or engage in a particular investment strategy. For additional information about Franklin Madison Advisors, including fees and services, please contact Franklin Madison Advisors or refer to the Investment Advisor public disclosures.